I'll never forget the day I lost tens of thousands of dollars in under 3 hours. Not because of a bad strategy, not because I didn't know what I was doing. I lost it because of something far more dangerous. Something that's probably destroying your trading account right now. And you don't even realize it. See, after 15 years of trading professionally, managing millions in capital, and mentoring hundreds of traders, I've discovered something that most people never talk about. The difference between traders who turn small accounts into life changing wealth and those who blow up repeatedly has almost nothing to do with technical analysis, indicators, or secret strategies. It has everything to do with what's happening inside your head. And today, I'm going to share the 4 psychological principles that changed everything for me. The same principles that allowed me to rebuild after that devastating loss and eventually achieve consistent profitability. But more importantly, I'll show you how these principles can work for you, whether you're starting with $100 or $100,000. My breaking point. Let me take you back to that day in 2016. I'd been on an incredible run, 8 consecutive winning weeks. My confidence was sky high. I developed what I thought was an unbeatable system for trading currency futures. And every morning, I'd wake up excited to prove myself right again. That morning started like any other. Coffee, charts, execution. Except this time, my first trade went against me immediately. No big deal, right? I'd been wrong before. But instead of following my risk management rules I'd followed religiously for months, something shifted in my mind. I told myself, this is just noise. I know this market. I know I'm right. So I held and held. And when it finally hit my mental stop, not my actual stop, because I'd moved that twice already, I was down $8,000. Now, here's where it gets ugly. A disciplined trader would have stepped away, reviewed what went wrong, waited for the next clean setup. But I wasn't thinking like a disciplined trader anymore. I was thinking like someone who needed to be right, someone who needed to prove that the loss was just a fluke. I opened another position, bigger size. I'll make it back, I told myself. 4 hours later, I was staring at a loss that represented months of hard work. My hands were shaking. My heart was pounding. And the worst part? I knew exactly what I'd done wrong. I'd violated every principle I'd spent years building. That night, I sat in my office until 2 a.m., not looking at charts, but asking myself one brutal question. If I can't control myself when it matters most, what's the point? Principle 1. The compounding mindset. The answer to that question came slowly, painfully, over the weeks that followed, and it started with completely reframing how I thought about trading success. Most traders, especially new ones, approach trading with what I call the lottery ticket mindset. They see their account balance and immediately start calculating. If I can just double this in a week, then double it again, then... I did the same thing when I started, we all do. But here's what I learned after that devastating loss. The traders who actually make it, the ones who compound small accounts into genuine wealth, think in decades, not days. Let me tell you about James, one of my mentoring students. James came to me 3 years ago with $500 and a story I'd heard 100 times before. He'd blown up 4 accounts already. Always the same pattern. Aggressive trading, big wins, bigger losses, back to zero. The first thing I asked him was, "What's your goal?" "I want to turn this into $50,000 as fast as possible," he said. I smiled because I remembered saying something similar when I started. "Wrong answer," I told him. "Your goal is to not lose that $500 for the next 6 months while you learn to think differently." He looked at me like I was crazy, but here's what I explained to him. And what I want you to understand. Compounding isn't just a mathematical concept. It's a mindset that fundamentally changes how you interact with the market. When you adopt the compounding mindset, you stop seeing your account as money you need to grow quickly. You start seeing it as a seed that must be protected, nurtured, and allowed to grow at its natural pace. Let me show you what this looks like in practice. If you start with $500 and grow it by just 5% per month, which doesn't sound exciting, I know, you'd have $16,000 in 5 years. But here's the part most traders miss. That same 5% monthly growth sustained for 10 years turns that $500 into over $200,000. But 5% per month is so slow, I hear you saying. Is it though? Most traders trying to make 20% per week blow up within 3 months. They're back to zero, starting over, caught in an endless cycle of boom and bust. Meanwhile, the trader targeting 5% monthly compounds steadily, never risking account death, building skill and capital simultaneously. I learned this lesson the hard way. After my $47,000 loss, I did something radical. I took $5,000, a fraction of what I'd lost, and I imposed strict rules on myself. No more than 1% risk per trade. No more than 3 trades per week. No revenge trading. For the first month, it was torture. I made $247. That's it, my ego screamed at me. At this rate, you'll never recover what you lost. But I kept going. Month 2, $312 profit. Month 3, $398. The account was growing, but more importantly, something else was happening. I was rewiring my brain. I was learning to value the process over the outcome. I was developing what I now call millionaire patience. By the end of the first year, that $5,000 had grown to $11,400. Not through heroic trades or lucky breaks, but through boring, consistent, disciplined execution. By year 3, it had crossed $45,000. And today, that account with no additional capital added sits at over $280,000. The compounding mindset isn't sexy. It won't give you stories to brag about at parties, but it will give you something far more valuable: sustainability. Here's what this mindset requires from you. First, you must redefine success. Success is not making money today. Success is following my rules today, regardless of the outcome. Second, you must embrace small wins. When you're trading a $200 account and you make $8, that feels like nothing. But that $8, if earned consistently, is the foundation of everything that comes after. Third, you must protect your capital, like your life depends on it, because your trading life does. Every dollar you preserve is a dollar that can compound. I remember talking to a trader who'd been featured in a documentary about Forex trading. He told me something I've never forgotten. The market doesn't reward brilliance, it rewards survival. Stay in the game long enough and the compound curve will do things that seem impossible at the start. He was right. The compounding mindset is what allowed Warren Buffett to become one of the richest people alive, not by finding secret investments, but by consistently making good decisions over 60 years. It's what allowed Jesse Livermore to recover from bankruptcy multiple times. It's what separates professional traders from gamblers. So here's my challenge to you. For the next 3 months, stop trying to double your account. Instead, aim for 3 to 5% monthly growth. Track not just your wins and losses, but your adherence to your rules. Measure your success by your discipline, not your dollar gains. Because once you internalize this mindset, once you truly understand that slow and steady doesn't just win the race, it's the only way to finish it, everything else starts to fall into place. Hold up for a minute, guys. Before we continue, I need to tell you about TradeZella, our sponsor and the #1 trading tool for serious traders. Whether you're trading crypto, futures, Forex, stocks, or anything else, TradeZella connects directly to your platform and automates your entire trade journaling process. Here's the reality. If you want to be consistently profitable, you need a proven trading edge. TradeZella helps you identify that edge, maintain it, and optimize it through automated journaling, in-depth analytics, backtesting, bar replay, and more. Click the link in the description to get the best discount always. Don't leave money on the table and lock in your discount today. Your future trading performance will thank you. Now let's get back to the episode. Principle 2, ruthless patience. Now, let's talk about something that almost destroyed my trading career before it really began: patience. You hear that word constantly in trading content. Be patient, wait for your setup. Don't force trades. It sounds simple, right? It's not. Because what most traders call patience isn't patience at all. It's just hesitation. Real patience, the kind that actually makes you money, is what I call ruthless patience. And it's one of the most difficult psychological skills to develop. Let me tell you a story that illustrates this perfectly. Back in 2012, I was trading stock options with a tight-knit group of traders. We'd all studied the same strategies, used the same analysis tools, and had similar experience levels. But there was one guy in our group, let's call him Marcus, who consistently outperformed everyone else. At first, we thought he had some edge we didn't know about. Maybe better information, maybe a more sophisticated system. So one day I asked him directly, "What are you doing that we're not?" His answer shocked me. "I trade about 1/10 as often as you do." I pulled up our trading logs. He was right. In a month where I'd executed 47 trades, Marcus had executed 6. 6 trades. And he'd made more money than I had. When I asked him to explain, he said something that completely changed how I viewed trading. Most of what happens in the market is noise. I'm only interested in the signal, and the signal only appears when everything aligns perfectly, so I wait. And while I'm waiting, I'm not doing nothing. I'm actively choosing not to trade. That phrase, actively choosing not to trade, hit me like a freight train. See, I'd always thought patience meant being able to wait a few extra minutes before entering a position, or holding a trade overnight instead of closing it at the end of the day. But Marcus was talking about something entirely different. He was talking about having the mental fortitude to watch the market for hours, days, or even weeks without pulling the trigger, knowing that his edge only appeared in specific rare conditions. That's ruthless patience. Let me show you what this looks like in my own trading. I trade primarily futures contracts, ES, NQ, and crude oil. My strategy is based on specific confluence setups that only appear a few times per week. Early in my career, I would see these setups forming and jump in at 70% probability. Close enough, I'd tell myself. But after studying my results over hundreds of trades, I discovered something crucial. My 70% setups had a 52% win rate. My 95% setups, where every single condition aligned perfectly, had an 81% win rate. Think about that. By waiting for complete alignment instead of partial alignment, I nearly doubled my success rate. But here's the psychological challenge. Waiting for 95% setups means passing on a lot of 70% setups. And when you pass on a trade and it ends up working, your brain torments you. See, you should have taken it. You're being too picky. You're missing opportunities. This is where most traders break. They can't stand the psychological discomfort of watching potential winners pass by. So they lower their standards. They take the 70% setups. And slowly their win rate degrades until they're barely breaking even. Ruthless patience is the ability to watch those potential winners pass without flinching, knowing that your job isn't to catch every move. Your job is to execute your edge when conditions are perfect. I learned this the hard way during my recovery period after that big loss. There was a 2-week stretch where the market was choppy and unpredictable. My system wasn't giving clear signals. I watched the charts every day, analyzing, waiting, and I didn't take a single trade. On day 11, I started to doubt myself. Maybe I'm being too cautious. Maybe I'm letting fear control me. The pressure to do something, anything, was intense. But I held firm. And on day 14, my setup appeared. Perfect alignment. I executed with full confidence and captured a 4.7R trade, meaning I risked $500 to make $2,350. That single trade made more than I would have made taking marginal setups all week, and it came with a fraction of the stress. That's when it clicked for me. Ruthless patience isn't passive. It's the most active thing you can do. It's a constant battle against your own impulses, your boredom, your fear of missing out. Here's how you develop this skill. First, you need crystal clear entry criteria. If your rules are vague, I'll trade when the trend looks strong, you'll never know what you're waiting for. But if your rules are specific, I trade only when price retests the 21 EMA in an established uptrend with RSI between 40, 60, and volume increasing. Then you know exactly what to wait for and everything else becomes easy to reject. Second, you must reframe what doing nothing means. When you're not trading, you're not being lazy. You're preserving capital, maintaining mental clarity, and positioning yourself for high probability opportunities. Third, track your patience. I keep a trading journal where I note every day whether I followed my rules perfectly, including the rule to not trade when conditions don't align. Some of my best trading days are days where I made zero trades, but stuck to my discipline. Let me share something personal. There are weeks where I'll be watching the market for 30 plus hours and execute maybe two trades. My family used to ask me, "Oh, what do you do all day if you're barely trading?" And I'd explain, "I'm waiting for my moment. When it comes, I need to be ready to act with complete confidence and full size. But until it comes, my job is to protect my capital and my mental energy." That's ruthless patience. It's the sniper waiting for the perfect shot while everyone else is spraying bullets and hoping something hits. It's the chess player seeing 20 moves ahead and refusing to sacrifice a piece just to create activity. It's the trader who finishes the year with 40 trades and a 75% win rate while everyone else took 400 trades and broke even. I want you to try something this week. Set a rule that you'll only take trades that meet 100% of your criteria. Not 80%, not 90%, 100%, and see what happens. You'll probably take fewer trades than usual, maybe a lot fewer. But I'm willing to bet the quality of those trades and your emotional state while taking them will be dramatically better. Because in trading, as in life, the hardest thing to do is often nothing. But nothing done at the right time is worth everything. Principle 3. Emotional detachment. Now we come to what I consider the most important and most difficult psychological principle in trading. Emotional detachment. Before you stop listening because you've heard this before, let me be clear. I'm not talking about becoming a robot. I'm not talking about not caring. I'm talking about something much more nuanced and powerful. The ability to separate your identity and emotional state from the outcome of any single trade. Let me tell you about the moment I finally understood this. It was 2017, about a year after my big loss. I'd rebuilt my account through disciplined trading, and I was feeling good. Then came a trade I'll never forget. I'd identified what I thought was a perfect short opportunity on crude oil. Every indicator aligned. The risk-reward was excellent. 1-4. I sized the position appropriately and executed with confidence. The trade immediately moved in my direction. Within 2 hours, I was up $4,200. My target was $5,000. So I held, feeling vindicated and brilliant. Then the market reversed, aggressively. Price shot back through my entry and was heading toward my stop loss. In the span of 15 minutes, I went from up $4,200 to down $1,300. Here's what happened next, and this is the critical part. Nothing. I felt nothing. I watched my stop get hit. I closed the trade. I noted it in my journal. Good setup, bad luck, proper execution, next trade. My wife, who occasionally watches me trade, looked at me confused. "You just lost over $5,000 from where you were. How are you so calm?" I smiled and said something that surprised even me. "Because that trade has nothing to do with me. I executed my process perfectly. The market just didn't cooperate this time. I'll execute my process perfectly on the next trade too, and over time, the math will work in my favor." That moment was when I knew I'd finally internalized emotional detachment, but getting there required years of work and some brutal realizations. The first realization is this. Every time you take a trade, you're making a probabilistic bet. Even if your edge gives you a 70% win rate, that means 30% of the time you'll lose. You can't control which trades end up in which category. All you can control is whether you follow your process. Think about it like this. If I gave you a coin that lands on heads 70% of the time, would you be devastated when it lands on tails? No, because you understand probability. You know that over 100 flips, you'll win more than you lose, even though individual flips are unpredictable. Trading works exactly the same way. But here's why it's so much harder. In trading, real money is on the line. And humans are psychologically wired to feel losses about twice as intensely as equivalent gains. This is called loss aversion, and it's one of the biggest killers of trading accounts. I saw this destroy a talented trader I knew. Let's call him David. David had incredible technical skills. He could read charts like Neo reading the Matrix. But he had one fatal flaw. He took every loss personally. When he won, he'd feel good for an hour, then move on. But when he lost, he'd spiral. He'd replay the trade in his mind, questioning every decision. I should have seen that reversal coming. I'm an idiot. I'm never going to make it as a trader. This emotional attachment to outcomes created a vicious cycle. After a loss, he'd either 1. Revenge trade, trying to make back the loss immediately by jumping into mediocre setups, or 2. Freeze up, becoming so afraid of another loss that he'd miss good setups. Either way, his emotions were controlling his trading instead of his strategy controlling his trading. I tried to help him. I showed him his numbers. Over 100 trades, he had a 64% win rate, and his winners were bigger than his losers. He was profitable, but he couldn't see it because he was so focused on individual losses. Eventually, David quit trading, not because he wasn't good enough, but because he couldn't separate his ego from his results. That's the tragedy of emotional attachment. So, how do you develop emotional detachment? First, you must accept that uncertainty is the only certainty. Every trade you take could be a winner or a loser. You cannot know in advance. Therefore, the outcome of any single trade means nothing. What matters is the statistical outcome over hundreds of trades. I used to write this on a sticky note on my monitor. This trade doesn't matter. The next 100 trades matter. Second, you must shift your focus from results to process. Your job is not to predict the market correctly. Your job is to execute your trading plan correctly. If you execute correctly and lose, that's still success. If you execute poorly and win, that's still failure. This mindset shift is massive. When I started measuring success by process adherence rather than P&L, everything changed. I'd end days where I lost money feeling good because I'd followed my rules perfectly. And I'd end days where I made money feeling concerned because I'd violated my risk management. Third, and this is crucial, you must size your positions small enough that individual losses don't create emotional damage. Let me be specific here. If losing a trade makes you anxious, angry, or desperate to make it back immediately, you're trading too large. Period. I have a rule. I never risk more than 1% of my account on a single trade. For most traders, that number should probably be 0.5% or even 0.25% when starting out. Because here's the thing. If you're risking 0.5% per trade, you can lose 20 trades in a row and still have 90% of your account left. That knowledge creates psychological freedom. When I was recovering from my big loss, I risked 0.5% per trade for 8 months straight. Some traders called me overly conservative, but I needed to rebuild my emotional relationship with losing. I needed to prove to myself that I could take a loss, feel nothing, and move to the next trade without hesitation. It worked. Fourth, you must maintain perspective. I keep a spreadsheet of all my trades going back 10 years. Whenever I take a loss that stings, I open that spreadsheet and look at the big picture. I see that 6 months ago, I took a similar loss, and the system kept working. I see that my worst losing streak was 7 trades, and I recovered. I see that my account has trended upward, despite hundreds of losing trades. This perspective is medicine for emotional attachment. Let me share something that might sound counterintuitive. The best traders I know actually experience relief when they take losses that follow their rules. Relief? How does that make sense? Because a loss that follows your rules proves you have discipline. It proves you can execute your exit strategy, even when it's uncomfortable. It proves you're not gambling, you're trading a system. I remember a trade where I was stopped out for a $900 loss. I literally said out loud, "Thank you," because 3 years earlier, in a similar situation, I would have moved my stop or held without a stop, hoping for a reversal. The fact that I took the loss automatically without hesitation showed me how far I'd come. That's emotional detachment. Here's a practical exercise I give all my students. For 1 month, don't look at your account balance. Only track whether you followed your rules on each trade. Win or lose doesn't matter. Just track. Did I follow my entry criteria? Did I place my stop where my system requires? Did I exit at my predetermined target or stop? At the end of the month, look at your account balance. I guarantee you'll be surprised. Traders who do this exercise almost always perform better because they've removed the emotional charge from their results. The final piece of emotional detachment is understanding that the market owes you nothing. The market doesn't care that you had 3 losses in a row. It doesn't care that you need to make money to pay your bills. It doesn't care about your hopes, dreams, or desperations. The market is simply a mechanism that processes millions of buy and sell orders. Your job is to interact with that mechanism objectively, without projecting your emotions onto it. When I finally truly understood this, it was liberating. I stopped feeling like the market was against me. I stopped personalizing losses. I started seeing trading for what it really is, a probabilistic game where discipline and emotional control are worth more than intelligence or prediction. So let me ask you, how many of your trading decisions are driven by emotion versus logic? If you're honest with yourself, I bet it's more than you'd like to admit. We all struggle with this. I still do sometimes, even after 15 years. But the goal isn't perfection. The goal is awareness. When you can catch yourself about to make an emotional decision, whether it's moving a stop loss, oversizing a position, or revenge trading, and choose discipline instead, that's when you know you're becoming a real trader. That's when the account balance starts to reflect it. Principle 4. Relentless adaptation. We've covered the compounding mindset, ruthless patience, and emotional detachment. But there's one more principle that ties everything together. One that I believe is the difference between traders who have one good year versus traders who build decade-long careers. Relentless adaptation. Let me start with a confession. Every strategy I used in 2010 is completely obsolete today. Every single one. The market I traded 15 years ago doesn't exist anymore. The volatility patterns have changed. The correlation between assets has shifted. The impact of algorithmic trading has exploded. Even the time of day when the best opportunities appear has evolved. If I'd stubbornly stuck to what worked in 2010, I'd have been crushed years ago. The traders who survive, who thrive, are the ones who understand that the market is a living, breathing, constantly evolving beast. And the only way to stay in the game is to evolve with it. This isn't just about adjusting your technical indicators. This is about fundamentally rewiring how you think about your edge, your strategy, and even your identity as a trader. Let me tell you about a painful period in my career that taught me this lesson. It was 2018. I'd been trading a momentum-based strategy on tech stocks for 3 years with solid results. My system was simple. Identify strong trending stocks, enter on pullbacks to key moving averages, and ride the momentum. It worked beautifully. Then, starting in October, something changed. My win rate dropped from 71% to 48% over the course of 6 weeks. My average win size shrunk. My losses came faster. At first, I thought it was bad luck. Variance. It'll revert to normal, I told myself. It didn't. By December, I'd given back 4 months of profits. I was following my rules perfectly, but the market had shifted. The beautiful, smooth trends I'd been trading had turned into choppy, erratic movements. What used to be reliable support levels were being violated constantly. I had a choice: blame the market and insist my system was still valid, or accept that something fundamental had changed and adapt. I chose to adapt. I spent 2 weeks doing nothing but research. I analyzed hundreds of recent trades, both winners and losers. I studied changing market conditions. I looked at volatility patterns, sector rotations, and broader economic factors. And I discovered something important. The market hadn't broken. It had evolved. The multi-day trends I'd been trading were being interrupted more frequently by algorithm-driven reversals and news-driven volatility spikes. The game had changed. So I changed with it. I shifted my time frame. Instead of holding positions for 3, 5 days, I shortened to 1, 2 days. I adjusted my risk parameters. I started incorporating volatility filters. To avoid trading during chaotic conditions, I even added a new rule: no positions held through major economic announcements. Within 6 weeks, my system was working again. Not the same way it used to work. Better because it was designed for the current market environment, not the one from 2 years ago. That experience crystallized something for me. Your strategy is a tool, not your identity. Many traders make the fatal mistake of becoming emotionally attached to their approach. They think, I'm a day trader, or I'm a swing trader, or I'm a breakout trader. And when the market shifts in a way that makes their preferred style less effective, they fight against it instead of adapting. But the market doesn't care what kind of trader you think you are. I learned to think of myself differently. I'm not a momentum trader or a mean reversion trader. I'm an opportunistic trader who uses whatever approach best fits current conditions. Some months, I'm aggressive because volatility is high and opportunities are abundant. Other months, I barely trade because the setup quality is poor and capital preservation is the priority. This flexibility, this willingness to be completely different versions of myself as a trader, has been the key to longevity. Let me give you a framework for relentless adaptation. First, you must become comfortable with discomfort. Growth happens at the edge of your comfort zone. When the market changes and forces you to adapt, it feels wrong. Your brain resists. It wants familiarity. But that discomfort is actually a signal that you're growing. I deliberately force myself out of my comfort zone regularly. Every quarter, I trade a completely different instrument than my primary focus, just to keep my skills sharp and my mind flexible. Sometimes I trade commodities, sometimes bonds, sometimes currencies. I don't expect to be an expert in all of them, but the exercise keeps me from becoming rigid. Second, you must be willing to kill your darlings. There are setups and strategies I loved, strategies that made me a lot of money, that I no longer use because they stopped working. And that's okay. Nostalgia has no place in trading. I had a student who'd made good money trading a specific reversal pattern for 2 years. Then, suddenly, it stopped working. But he kept trading it because it always worked before. He lost 6 months of profits before finally accepting that the pattern's reliability had degraded. When I pointed this out, he was almost offended. "But this is my edge," he protested. "No," I told him. "Your edge is your ability to identify what's working now and execute it with discipline. The pattern is just a tool, and tools wear out." Third, adaptation requires brutal honesty. You must track your results meticulously and be willing to see the truth even when it's uncomfortable. I review my performance every Sunday. I look at win rate by setup type, average profit per trade, worst drawdown, time of day performance, market condition performance. If I notice any metric degrading over 4 consecutive weeks, that's my signal that something needs to adjust. I don't wait for disaster. I adapt proactively. Fourth, and this is critical, you must adapt not just to the market, but to yourself. You are not the same trader you were a year ago. Your life circumstances change. Your risk tolerance evolves. Your psychological triggers shift. I remember when I had young kids at home. My trading style had to adapt because I couldn't sit at my computer for 8-hour stretches. So I shifted to swing trading with clear, automated exits. It wasn't about the market changing. It was about my life changing, and my trading needed to reflect that. Similarly, as your account grows, your psychology changes. The trader managing a $5,000 account thinks differently than the trader managing a $500,000 account. If you don't adapt your approach as your capital grows, you'll sabotage yourself. Let me share a story about adaptation that still inspires me. There's a trader I met at a conference. Let's call him Robert. He'd been a floor trader in the Chicago futures pits in the 1990s. He was incredibly successful, making millions per year through open outcry trading. Then electronic trading took over. The pits closed. His entire edge, his ability to read body language, hear order flow, feel the pulse of the market, became obsolete overnight. Many of his colleagues retired or failed, but Robert adapted. He learned to code. He studied algorithmic trading. He completely reinvented himself as a systematic trader. It took him 3 years to become profitable again, but he did it. When I asked him how he managed such a dramatic transformation, he said something profound. "I wasn't a pit trader. I was a trader who happened to be in the pits. When the pits closed, I was still a trader. I just needed a new environment." That's the mindset of relentless adaptation. You're not defined by your current strategy, your current time frame, or your current approach. You're defined by your willingness to do whatever it takes to maintain your edge in an ever-changing environment. Here's what I want you to do. Look back at your trading over the past 6 months. Has anything changed in how the market behaves? Have any of your setups become less reliable? Are you holding on to approaches that used to work but maybe don't anymore? Be honest, brutally honest. Because here's the reality. The market will force you to adapt eventually. The only question is whether you'll do it proactively, on your own terms, or reactively after you've lost significant capital. I choose proactively, always. Relentless adaptation is what allowed me to survive the 2020 COVID crash when many traders were wiped out. I immediately recognized that normal correlations had broken. I reduced position sizes. I shortened time frames. I avoided sectors with extreme uncertainty. It's what allowed me to navigate the 2022 rate hike environment, when growth stocks collapsed. I pivoted to trading volatility itself rather than directional moves. And it's what will allow me and you to navigate whatever the market throws at us next. Because there will always be a next. The market will always change. New technologies, new regulations, new economic regimes, new correlations. Change is the only constant. But if you commit to relentless adaptation, change becomes opportunity instead of threat. You stop fearing market shifts and start embracing them as chances to evolve, to sharpen your skills, to rebuild your edge. And that, more than any single strategy or indicator, is what will allow you to build a trading career that lasts not just months or years, but decades. In closing. So here we are, 4 principles, 4 cornerstones of trading psychology that took me 15 years and countless painful lessons to fully understand. The compounding mindset, ruthless patience, emotional detachment, relentless adaptation. These aren't just concepts. They're not theoretical ideas to nod along with and forget. They're the actual practical framework that separates traders who make it from those who don't. And I want to leave you with one final thought, something that took me far too long to realize. When I started trading, I thought success meant being right. I thought it meant predicting the market correctly more often than I was wrong. I thought it meant having the best indicators, the most sophisticated system, the deepest analysis. I was completely wrong. Success in trading has almost nothing to do with predicting the market. It has everything to do with managing yourself, your emotions, your impulses, your ego, your discipline. The market is just price moving up and down based on billions of individual decisions. You can't control it. You can't outsmart it. You can't bend it to your will. But you can control you. And that self-mastery, is where the real edge lives. I think back to that day in 2016 when I lost $47,000. At the time, it felt like the end. I questioned everything: my ability, my judgment, my future in trading. But looking back now, that loss was the best thing that could have happened to me. Because it broke me. It shattered my ego. It forced me to rebuild from scratch, not with better indicators or smarter analysis, but with better psychology. The trader I am today, the trader who's achieved consistent profitability, who's weathered crashes and boom markets, who's built genuine wealth through trading, that trader was forged in that fire. And if you're struggling right now, if you've blown up an account, if you can't seem to find consistency, if you're feeling frustrated and lost, I want you to know something. You're not broken. You're not incapable. You're just learning the wrong lessons. Most traders spend their entire careers trying to find the perfect strategy, the magic indicator, the secret setup that will finally unlock success. They jump from system to system, always searching for that external solution. But I'm telling you, after 15 years of doing this professionally, after mentoring hundreds of traders, after making millions of dollars and losing hundreds of thousands, the solution isn't out there. It's in here, in your mind, in your psychology. The 4 principles I've shared today are not quick fixes. They won't make you profitable overnight. In fact, they'll probably slow you down at first, which is exactly what needs to happen. But if you commit to them, if you truly internalize them and let them reshape how you think about trading, they will change everything. You'll stop fighting the market and start flowing with it. You'll stop gambling on hope and start executing with confidence. You'll stop being controlled by fear and greed and start operating from a place of discipline and clarity. And over time, maybe months, maybe years, but over time, you'll look back and realize that you've become a completely different trader, a professional, someone who treats this craft with the respect it demands. I want to leave you with a challenge. For the next 30 days, I want you to focus on just one of these 4 principles. Pick whichever one resonated with you most. If you struggle with impatience and overtrading, commit to ruthless patience. Set a rule that you'll only take setups that meet 100% of your criteria, and track every day whether you honored that rule. If you struggle with inconsistent results and giving back profits, commit to the compounding mindset. Set a modest monthly percentage goal and focus on hitting it through disciplined, small wins. If you struggle with emotional swings after wins and losses, commit to emotional detachment. Size down your positions until individual trades don't create emotional reactions, and measure success by process rather than profit. If you struggle with a strategy that used to work but doesn't anymore, commit to relentless adaptation. Analyze your recent performance honestly and make one significant adjustment to fit current market conditions. Pick one, master it, and then come back and add another, because this isn't a sprint. This is a marathon. And the traders who win marathons aren't the ones who start fastest. They're the ones who maintain their pace when everyone else burns out. I'm living proof that it's possible to come back from devastating losses, to rebuild, to succeed, not because I'm smarter than you or more talented, not because I have access to information you don't, but because I was willing to do the hardest thing a trader can do. I was willing to change myself. The market you're trading today is the same market that's created countless millionaires. The opportunity is there, it's real, but it's not waiting for you to find the perfect strategy. It's waiting for you to become the right kind of trader. Someone with the patience to wait for quality setups. Someone with the discipline to protect their capital. Someone with the emotional control to execute their plan regardless of recent results. Someone with the flexibility to adapt when conditions change. Become that trader, and the account balance will take care of itself. I believe you can do this, not because I know you personally, but because I know this path works. I've walked it. My students have walked it. Thousands of successful traders before us have walked it. The principles don't change. They're timeless. They worked in the 1920s when Jesse Livermore was trading. They worked in the 1980s when the legends were making their fortunes. And they work today in our modern, algorithm-driven markets. So start today, not tomorrow. Not when you have more capital or more time or more knowledge. Today, take one principle. Write it down. Put it somewhere you'll see it every day. And commit to living it in your trading. Your future self, the one who's achieved the financial freedom and consistency you dream about, is watching. Make them proud. Thank you for spending this time with me. If this resonated with you, subscribe to the channel, because I'll be sharing more insights from my years in the trenches, the good, the bad, and the brutally honest truth about what it really takes to succeed. And here's my question for you. Which of these 4 principles do you struggle with most? And what's one specific action you're going to take this week to improve it? Drop your answer in the comments. I read every single one, and I'll be there to offer guidance. Until next time, trade smart, trade safe, and remember, the market rewards patience, discipline, and adaptation. Everything else is just noise.